Invite on stage Shahzad from Nippon Life India AF Management Limited. Round of applause, everyone. Andrew Holland from Avendus Public Markets, and to moderate, none other than Nisha Poddar from CNBC TV 18. And we have also we've got Ravi joining in the panel. So inviting you, Ravi. A round of applause, everyone, for Ravi. Nisha, where are you? Yeah, please settle in. Yeah, maybe if we can just very quickly, in the interest for the diverse set of audience, have a quick round of introductions from the speakers.
Hi, my name is Ravi Ukadala. I head Northern Arc Investments. We run alternate investment funds in the fixed income segment. So I'm here to provide the asset class diversity to this panel. About 3,500 crores of assets currently and about 5,000 crores of commitments across 9 successful funds.
My name is Shahzad Madon. I represent Nippon Life India Alternate Investment Management Company. So we manage Category 2 and Category 3 funds, typically across public equity, which is Category 3. We do a little bit of VC, real estate, credit. This is what we do today. 15 closed funds, 3 funds currently being raised under, and 4 funds applications with for launching shortly.
Hi, my name is Andrew Holland. I'm the CEO of Avendus Alternate Strategies. We run mainly Cat 3 hedge funds, both fundamental long-short and quant strategies as well, with about $700 million of assets under management.
Thank you, everybody, for the introduction, and I'm sorry that I got late. This is Nisha Poddar from CNBC TV 18. This is one of the most interesting conversations I had on the sidelines of the summit, actually, so far with the panelists. And we are here to address this very special category of an investment product, and I'm sure it's a room full of HNIs, and most of you understand this particular product. It had its inception about a decade back, and in terms of traction, understanding, we have to see where it has reached, and some of those notions around this product will get addressed by our esteemed panelists. Okay, so it is essentially synonymous sometimes to hedge funds. By definition, it is complex trading strategies when we talk about the Category 3 funds of the alternatives. Now, when we look at the perception around this kind of a product for investing, it has been often called hot money or else wild west of investing. So Shahzad, you want to address that, why wild west of investing?
I would say that's probably an unfortunate misconception, because let's look at the following. Let's look at the underlying. So what does Category 3 comprise? So about 2/3 of that, 68-ish%, is long-only equity, not too different from what you have in MF and PMS. There are a few differences. We'll talk about that later. There is about 28%, which is long-short absolute returns, thereabouts. That's the balance. And then you have, let us say, budding categories, which would be multi-asset credit, which is a growing category. So to that extent, if you look at the underlying, it's not particularly different from what goes into any category. Maybe this perception comes about because of the very definition, which is complex trading strategies. That's probably one reason. And the fact that there is use of leverage, there is potential for use of leverage. That's not used too much, but that's probably it.
So leverage funding, is that one of the issues which makes it look like more opaque, Andrew? Is that one of the issues? What's your view on the perception built around it? And do you think now investors who have the ability to invest over 1 crore, they understand these sophisticated products in India?
So two parts to that answer. The first is this perception. So let me try and kind of address that. So if you think about debt and equity, you have a risk curve. And the risk curve is debt is at the low end, and obviously equity is at the high end. So the funds that we manage and hedge funds, one is mainly towards the volatility of this fund is about 3.5%. Most debt funds are 3.5%. Our drawdowns are less than a lot of the debt funds over the years. So I don't see, that I'm offering products which are more risky than some of the debt funds which you all invest in. And on the equity side of it, we have funds which will either enhance your returns, so you get better returns over the Nifty, or protect your capital when the market's falling. And that's what investors look at. So when we go meet high net worth individuals, and you have to meet them, it can't just be sold as a product which they don't understand. They get the fact that you're going along that risk curve to offer them different products from debt or equity. And in terms of equity, you're helping to protect their capital, which is what they're really kind of trying to do in these kind of markets. So this is why the category has grown so quickly over the years. But it does take that kind of explaining, and I think the perception, obviously, if you can explain to people how you're moving them around the risk curve, makes them feel a lot more comfortable.
Right. I'm glad you mentioned the debt side also and the risk, parameters around it. On this panel, I must specify that, long short as well as the credit. All three main categories of Cat 3 fund is represented, so we can address each one of them. Now, when we talk about the risk and the leverage funding aspect, those aspects are not really an issue when we talk about the credit product under category 3 fund. So Ravi, so you don't face the perception issue as such of high risk at times because it's credit linked, but then why low traction in this product?
So the traction is not low. We have more than 500 investors across 4 years in this one product, which is about 1,500 crores. But as the discussion has already happened, category 3 itself is thought of as it can cover a wide range because it provides flexibility. So the investment manager has flexibility to design the product however they want and use instruments underlying however they want. So whether it's options, whether it's leverage, whether it's plain vanilla, you can do all of this. And hence, when you go to an investor, the investor has to put in the effort to understand what are the risks around that product. For the debt side, we run a pretty vanilla kind of product, which is a highly diversified credit risk fund, which because of the allowance of flexibility removes both the liquidity risk as well as the market risk. So for those who have followed the mutual fund story about a credit risk fund being shut over the last few years, the problem was not credit. The problem was when you go to sell the credit in the market, at the time of exit, there are no buyers. And the category 3 fund allows you to flexibly design such that the liquidity risk is mitigated to a large degree. So that is what we have used. And once we do explain this product, and it becomes more of a habit because today in our fund we have corporates, we have family offices, HNIs, who invest from a period of 4 to 6 months in a category 3 kind of fund. And hence, it took a couple of years for that traction to get built in. But now on a monthly basis, we have flows of anywhere from 200 to 300 crores in and out. So underlying product is such.
Very quick question. Have you seen traction increase with interest rate rising? Because that's when fixed income becomes more prevalent.
Yeah, so to put it mildly, is the year of fixed income is what is
so good
said.
times ahead for you, Ravi.
Yeah.
But I want to address one more aspect. When we talk about this being a high, more sophisticated, tailor-made kind of a product, it also is a more high margin and more pronounced product for the seller, for the wealth managers and fund managers in this business. So, Shahzad, between mutual fund and AIFs, is there an arbitrage play and is there more push towards AIF because also the fee structures are different and you make more money out of alternatives? And is that also an issue that probably the conception and the perception is built around?
A very fair question and very good question. I would put it in the following manner. See, alternate investment funds, if you look at globally, is where investors graduate towards. So, for example, in India, you would first start with a mutual fund, you'd do your SIPs, you'd do lump sum, you'd do PMS, then you move into alternate assets. Now, alternate assets, the issue which you raised is across all categories. It's across category 1, 2, 3. Maybe people ask for it more in the context of category 3, because, say, and in category 3 long only, because that's something which can also be done through an AIF, a PMS, and a mutual fund, right? Yeah. But let me put it this way. I am yet to see a stupid HNI, right? A guy who has typically a 1 crore ticket is fairly smart, who can invest 1 crore, a single pop, typically has a wealth of 15 to 20 crores. He's seen the entire, all the investment propositions. It's highly unlikely he could be, let's put it this way, it's going to be a little more difficult to be able to sell him a story which he's hard to believe.
All right, so they understand the product as well as the risk involved in it, and they have the appetite for it.
And one last thing, Nisha, if I could just say here on this one. See, when you even compare equity, and you may say it's public equity, right? You can do that through a mutual fund, you can do that through an AIF. So what's the difference? There's a huge difference. See, mutual funds at this point in time are getting increasingly regimented. They're looking more similar one to the other, and that's correct. Yeah. That's the way they have to go. But the freedom you have in an AIF, and consequently the potential for alpha generation, I used the word the potential for alpha generation, is significantly higher in an AIF. As long as you can deliver that alpha, you will get investors willing to pay you. That's the way I would see it. But you have to deliver value. Else no HNI will subscribe to your fund.
I would call it a more premium product with high margin, high risk, and therefore high returns also.
That's correct.
So Andrew, but the problem here is that the CAT 1 and 2 funds do get insurance and pension funds, but category 3 cannot attract these two categories of funds. And they are more cautious in their approach when it comes to investments. So is that one issue, and is that something which is a hot topic of discussion in the industry?
I mean, obviously, again, I'm not sure why they can't invest in terms of their rules, but it goes back to the very simple fact that the perception about Cat 3 is really quite low in terms of the risk-adjusted returns that you can make for clients. And I think once that's understood more clearly, I think, pension funds, banks, as they do elsewhere in the world, will come to these types of products. So it's just really the understanding of how you move, I mentioned before, around this risk curve to either enhance returns on the equity side and protect capital, or on the debt, when you compete against debt products, of getting 2-3% more than a debt product with the same type of risk. And remember, our products in Cat 3 in the hedge funds, there's no entry loads, there's no exit load. You get monthly liquidity. I don't see how that's showing you that you have a risky product which you're going to be tied in for a long time. Most clients come for a year plus into our main debt fund. Our debt equivalent fund, and for the equity side of it, obviously they're on the more to 2 to 3 year horizon, as they would do in any kind of long only fund on the mutual fund side. So I think it's really education. When we first started back in 2013 and still today, I think we probably meet 99% of all investors that come into our fund with regular updates. So they start to kind of continue to understand the product more.
All right, so education is one thing, but one of the other issues is also that high taxation. What is the problem around that, and can this be solved in consultation with the government?
Yeah, I mean, I don't know how many times I've been to the tax departments in Delhi, but I don't quite understand if you're an investor, single investor, and your tax rate is, say, 25-30%, under a Cat 3 fund similar to ours, because we're using derivatives, you're charged 42%. And I don't know why that would be if, for the same product, you're being charged a different tax rate. So I think that would really be both the insurance companies and the banks being allowed, and taxation being more of a level playing field, you'll see this industry grow very, very quickly. So I'm hoping that will change, that perception will change within the tax departments in Delhi.
But I've seen many investment products have very high taxation when they come into being, and then over time with industry lobbying hard with the government, it has come down as it's more in circulation and the education is more. So probably patience is required there, but taxation is not an issue, Ravi, when it comes to credit-linked products in category 3.
So taxation is not an issue to the extent that the tax is in the pan of the investor for us, unlike in an equity where there is a variability. But taxation is still at the vehicle level. In India, across different vehicles, you have different taxation. In mutual fund, it's a pass-through. In insurance, if you do switching, it doesn't count as capital gains, but where in mutual funds you can. In AIFs, you're taxed differently based on category 2 or category 3. So there is a structure level taxation, and then there is an investment level taxation, and all of this is misaligned today across all asset classes, whether it's gold, real estate, and all of these financial instrument vehicles. There's supposed to be a revamp. Hopefully that'll bring it through, but...
Yes.
So may I just add to that? Cat 3, unfortunately, is the only category where you don't have a very specified investment, a specified tax framework. For example, Cat 1, Cat 2, it's very clear what you'll do. MF is very clear what the taxation is. REIT InvIT is very clear. Only category 3, there is no clarity. Hence, it is taxed at the fund. That's
Right.
what we're saying, which is unfortunate because that's the only, to our mind, the only SEBI-registered investment vehicle which suffers from this tax, let's call it burden.
All right, I have very quick 2 questions, important ones. So Shahzad, why don't you address how unattractive this can become if the minimum capital commitment regulation around it that has been floated by the market regulator as a discussion is really increased?
So let me put it this way. A lot of the investment comes in at the minimum 1 crore ticket size. As we all know, 1 crore is a fairly large ticket size in the context of this country, in the context of per capita income of this country. However, see, I think the minimum ticket size needs to be looked at in conjunction with a lot of other things. There is also talk about an accredited investor framework coming into play. When you look at that, because I think to look at the issue, which comes probably from the larger issue of mis-selling, to look at that issue, which is a very valid and important point, I think one needs to look at it holistically, right? Yes. So the way you addresses it from a rather holistic perspective, ticket size is one of them, but it's only one of the aspects you need to look at.
All right, so ticket size is one, and you're saying accredited investor. That could also be a solution?
A framework which is practicable, which which can be scaled up rapidly, should certainly be something which the industry welcomes.
All right, and Andrew, your final words on the recommendation so that there is a mid path so that this particular category of investment, the category 3 funds, are made more attractive, and the perception of its opacity right now is also minimized.
So I do have some strong views on the last question. In that, you see, elsewhere in the world, most hedge funds, Cat 3 funds, would be minimum ticket size is about $100,000 or around a crore. If we increase that, I think 2 things. One, let's just say you're a new hedge fund or a new Cat 3 fund starting up. It's very unlikely you're going to get people just committing more than a crore, or they say it's 2 crores or 5 crores, because they want to see your track record. They want to see how you develop. And if you take that a lot further forward, so you could be stopping new funds starting. And one of the things about, say, Gift City is to get talent in there which can attract offshore money into India. Now, if you don't have track record in India, you don't get money offshore. So I think we're hurting ourselves along the whole path of raising money domestically, but potentially raising money offshore as well.
All right, so those are the pitfalls. So just the final summation here, when we talk about the category 3 fund of the alternatives, here the suggestion by our panelists is that, yes, there needs to be more education, and solutions could be around accredited investor category as well. But on the other side, Ravi is quite happy that the fixed income group, because of the interest rate heightening cycle, is probably coming more in vogue at the moment. But the differentiation between mutual funds as well as category 3 AIFs, that's one of the key educations that investors need to know. But of course, this is for HNIs, and they are considered to be a much more sophisticated lot of investors there. Thank you so much, Ravi, Shahzad, as well as Andrew, for adding to this conversation and in the education of category 3 funds. Thank you so much.
Thank you, Nisha.
Thank you.